All right, so continuing on with depreciation, we're going to be taking a look at the second part of depreciation, which is going to be double declining, okay? So double declining, right? Depreciation we already as known as when you purchase your assets, they lose value over time because you're using your assets. Well, in this case, right, same components, same 5 components that you need to have in order for you to complete your depreciation. So again, number 1, cost of the asset. Number 2, estimated useful life, salvage value. And then here we have date that you place into service. And then last but not least, depreciation method, okay? But because we already looked at all of that stuff the previous day, right? Those are all going to be the same. However, the only difference here is how we're going to depreciate it, okay? So we're going to be taking a look at accelerated, or also known as double declining method, okay? They're interchangeable. So whether it's accelerated or whether it's double declining, they both mean the same thing. But here, we have to understand what is so important about using the double declining method. Well, here is the idea here. The formula is different for sure. However, the reason why we would use double declining is that the assumption here is that when we purchase these assets, right, we tend to use it more often and more frequently in the beginning of its years. So therefore, we are going to be actually depreciating it twice as much, okay? All right, so think of it when you guys bought a laptop for school, right? You'll use it so much in the very beginning of your first couple years in school, and then as you get through and going on through your career or reach the end of your career, you start to use it less and less and less. And when you graduate and you start working, you use it a lot less then, all right? Same idea here. You tend to use the asset in its beginning of its years, though, a lot. And then as time goes by, you start using it less and less and less. So in this case, that's exactly why we would use double declining. Because in most cases, right, if you're using a fixed asset more frequently, right, then obviously, and you're going to be depreciating it twice as much, the idea here is that you're going to get rid of it a lot more quicker, okay? So here are the formulas. Now, here, there's the 3 main formulas, which is the depreciation basis, the depreciation rate, and the depreciation expense itself is going to be different, okay? The accumulated depreciation and the book value, these ones will stay the same. So it's going to be the previous year's accumulated depreciation plus the current year's depreciation expense. And book value, once again, is going to be the cost of the asset minus accumulated depreciation, okay? But here's the catch. When we actually determine what the depreciation basis is, it's going to be determined by beginning of the year's book value. So here, we're constantly calculating the book value, right? And then for this depreciation method, we're constantly using it, okay? So if the book value at the end of year 1, right, which then means it's the beginning of the year for year 2. So in this case, we have to solve for the book value in order to go ahead and continue depreciating the asset, okay? All right, so then the second thing here is going to be the depreciation rate. This is going to be 1 over the estimated useful life times 2, okay? Because 1 is a whole number, right? And I'm going to divide that by the number of useful life it has. And I'm going to multiply it by 2 because we're depreciating it twice as much. So this is the context here, right? This is how much I'm going to be costing my asset over its life, right? If it has 5 years, then I'm going to split my asset's life into 5 years. But this time I'm going to double up on it because I am going to depreciate it twice as much. Okay? And then last but not least, we have depreciation expense, which is going to be your depreciation basis times your rate. Okay? And so on and so forth. So let's go ahead and take a look at an example. Okay? So here we have we purchased a machine for $15,000. The salvage value is $2,500. Useful life is 5 years. And the number of units that it could produce is 10,000. And the date that we placed into service was January 1st, okay? So in this case, I need to solve for my depreciation basis first, okay? So now we know that the depreciation basis is going to be the beginning of the year's book value. Right now, because it's its first year, my assumption here is that the book value is going to be whatever the asset cost, because that's what it cost me, and that's what it holds its value at. Right now, it is $15,000. Okay? So now we have to solve for the depreciation rate. In this case, right, it's going to be 1 over the estimated useful life times 2. So in this case, right, what is my estimated useful life? 5 years. So 1 divided by 5 times 2 should give you 40%, 0.4, however you want to use it. But in this case, if I calculate it, it should be 0.4. And if I'm using the calculator. 0.4, right? Because it's percentage, right? Therefore, I'm going to depreciate it 40% every single time. Okay, so here depreciation expense is also going to be my depreciation basis times my rate. So in this case, what is 15,000 times 40%? 6,000. You missed a 0. Okay. So times 40% gives you $6,000. Same thing here. It's going to be whatever the beginning of the year, because there is no previous year. So then now I have to calculate my book value, because at the end of year 1, what is my book value actually worth?
$9,000?
It's going to be worth $9,000. So therefore, at the end of year 1's book value is going to be $9,000. Therefore, what should be my book value, my depreciation basis for year 2? It's going to be $9,000, right? Because in this case, the beginning of the year is the same thing as the ending of the year of the previous year. So in this case, you're right. It is going to be 9,000. Okay. Now let's go ahead and continue here. What's my rate going to be this time? My rate is the 1 over divided by its number of useful lifetimes 2.
3,600.
Good. It's going to be 40%, right? Which you take 40% of 9,000 to give you 3,600. Which then now, if you continue its calculation, your asset is now $5,400. Okay?
Is a method the rate also remains constant?
That is correct. And that's the next thing I'm going to show you here. Okay? Book value cannot be below salvage value. So as you keep going through it, you're going to notice, wait, it's not even at its end of its life yet. But what you're going to notice is that your book value should always be equal to salvage value, right? That's what we have to remember, okay? So in this case, right, if you look at the previous one, right, once we reach year 4 and we keep depreciating it, right, because we're doing it twice as much, here we notice that the rate is the same, yes, but the depreciation basis will always change, all right, because of the book value. But in this case, it's only in year 4, and my book value has fallen below salvage value, okay? Once I'm here, I cannot ever have my book value be lower than salvage value. So in this case, I have to work backwards, okay, to get to where I need to be. So in this case, for a fact, I know that my book value must equal to salvage value. So therefore, this must be 2,500. Okay. Now from here, I need to work backwards because here I'm given one key thing, and that is I have my book value, right? If you take your formulas, you can use order of operations, or you can do math, simple math, right? If A plus B equals C, that is also equal to A equaling to C minus B, which is also equal to A minus C equaling B. All right? That's the same idea here. You're just flipping and moving things around. So in this case, you're still going to get the same answer. But in this case, I know what my book value should be at. It has to be equal to salvage value, which is 2,500. So now I have to work backwards because I know what my book value is, right? Book value equals accumulated depreciation, or asset cost minus accumulated depreciation. I know what my asset is, right? It's worth $15,000, right? 15 minus my book value is going to give me 12,500, right? And then from here, I'm going to be working again backwards one more time because the end goal here is I need to solve for what is going to be my depreciation basis, or in this case, my depreciation expense for year 4. So once again, the formula to solve for accumulated depreciation is the previous years minus the current years. In this case, I have my accumulated depreciation of 12,500. I'm going to subtract out my previous years of 760 to get a total depreciation expense of 740. Okay? Now let's notice this. My asset only lasted 4 years. In this idea, the reason why it has a shorter lifespan is because you are depreciating it twice as much. As in, you're trying to get rid of it as soon as possible. So sometimes it can hold to its life. It can go beyond its life. At the end of the day, as long as you get to this point here where your book value is equal to salvage value, then you're done. Okay? So yes, notice this, right? My asset never made it to 5 years. The depreciation basis is going to be the book values. Okay? The rate stays the same. And again, once again, here your end goal is that the book value should equal salvage value. Okay? Any questions in regards to double declining?
Can you go back one slide, please? So if in the last case, we go on the book value, we go lower than the 2,500, we're gonna dismiss that amount and then we're just gonna go backwards.
Mm-hmm.
We have to do the 25. We cannot
Mm-hmm.
use the other amount, correct?
Mm-hmm.
Okay.
Because book value cannot fall below salvage value.
Okay, you said, okay, the book value should always fall below,
Should be equal to
should be
salvage
equal
value.
to,
Mm-hmm.
okay.
Thank you.
Mm-hmm. Okay. Now we're going to practice journalizing it, right? As we've mentioned before earlier, right? Your journals are going to look identical to each other, okay? Because the only difference here is just the numbers. So for this example here, it says to journalize the first years of depreciation expense. You're going to do the same thing here. You're going to recognize the same accounts, depreciation expense and accumulated depreciation. But this time, right, my first year was 6,000. So boom, 6,000, right? Same thing for second year. The accounts stay the same. However, the number holds differently. Okay? So then let's go ahead and talk about what happens when partial years come into play. So once again, we took a look at this for units of production. However, it didn't seem to matter how old the asset was because at the end of the day, you're always calculating how much you've spent or produced that year. In this context right here, partial years is a huge contributing factor because once again, it depends on when you place the asset into service because when you place the asset in the end of the year, beginning of the year, in the middle of the year, you have to realize that the asset is only so many months years old. You shouldn't depreciate it for a whole year. It still has some life to live. Okay? So in this case, right? I bought a machine that's worth $10,000 with a salvage value of $2,500. Its useful life is 5 years, and the number that it could produce is 25,000. With the date that we placed in service was October 14. So in this case, right, when do I start depreciating it?
November.
Why November?
We still have 3 months left from that year, right?
Well, in this case, right, when am I going to start depreciating my asset?
October because it's before the 15th.
October because it's before the 15th, right? You used at least more than 50% of the machine, right? You did it one day more earlier. So in this case, right, because you placed it in service on the 14th of October, therefore the assumption is that you're going to start using it as you know, in October. Okay? So therefore you have October, November, and you have December. It is 3 months if you start depreciating it every year. So in this case, if I started in October 14, I have to depreciate for the month of October, for the month of November, and the month of December. Okay? So let's take a look at here, right? Here's my first years. Okay? So what's my depreciation basis going to be?
The cost of the asset.
Good, which is
10,000.
10,000. What's my rate going to be?
one, would that be 10% or
Oh,
9%?
for the depreciation rate?
Yeah,
Okay, so it's 1 over its estimated useful life times 2. What's its estimated useful life?
5 years.
5
Which is
years.
5. So it will be 1/5 times 2.
Yes, 1 over 5 times 2.
0.4.
0.4. Okay. And last but not least, what is 0.4 times 10,000?
Is it 4,000?
Okay. So that's exactly correct. Now here, let's take a look at this. This is going to be the depreciation expense for 1 entire year. But how old is my asset?
3 months.
It's only 3 months. So in this case, we have to recalculate this because that is depreciation expense for the whole year. Okay? Because it's only 3 months old, we need to also cut this in terms of months because I'm not going to depreciate it for a whole year. That's 11, no, excuse me. That is 9 months that I used up without even considering it, right? I got rid of 9 months and I barely used it. So in this case, I need to make this comparable or I need to calculate it so it reflects that for the first year, I only used 3 months worth. So in this case, right, calculation here is we understand that 3 months, right, out of 12, right, because if this is for 1 whole year, okay, so 3 divided by 12, which we know to be 1/4, or also known as 25%. Okay, but because this is the depreciation expense for the whole year, you're gonna actually have to take the 4,000. You can either do this. Now, the easiest is you could divide it by 12 and then multiply it by the number of months that exist. Or if you can use it as a fraction, I would take my 4,000, times it by 3, and divide the whole thing by 12. And I would get the same exact answer. All right? I could also do 4,000 times 0.025 because 3/12 is also equivalent to 1/4. And I would get the same answer here, right? But the easiest way to be able to do this is you take your 4,000, divide the whole thing by 12, then multiply it by 3. Okay, so then you can determine, okay, if this is how much it's going to cost me per month, and I used 3 months worth of it, there you go. Then you were able to solve your answer here, and it should be 1,000. Okay. Any questions here? So in this case, I'm saying for my first year, I placed my asset into service on the October 14. So therefore, I should only depreciate it for $1,000. Okay. Is everyone good here?
Yes.
Okay. So in this case, right, I want to make sure that I let the books know that my asset is only 3 months old. Okay? So that means on the first year, I can only record a fourth of the actual depreciation expense. Okay? So once again, journalizing it is the same journal. And this time, because we calculated that it is for just that 1,000, boom, 1,000. Okay. Any questions there? So once again, here is the formulas that you need to know for double declining. Okay. Once again, depreciation basis is going to be the beginning of the year's book value. Okay, the rate is going to be 1 over its estimated useful life times 2. And depreciation expense is going to be basis times rate. Okay. For any reason that salvage value does fall below, or book value falls below salvage value, you're going to have to work backwards to solve for what the depreciation expense is for that year, because you cannot go beyond its the cap, right? The cap is that the salvage value must hold a value and you cannot fall below it. Okay. Any questions for 11.2?
I do have one. Can you please go back to the last slide before the review slides? One more. Because it was the first year, that's why you didn't finish with the accumulated and the book value.
Oh no, I just want to get the concept through. Because again, accumulated and book value is the same, but in this case, I'm not continuing on to this. So
Because it's just 3 months, or it's just because of the lecture?
it's just the lecture.
Okay.
Yeah, because if you were to go ahead and continue it on,
Yeah. Can you
then
pass
you
it
would
out
know.
so I can see if it matches?
I'm sorry?
Can we do number 2?
So accumulate value and
Second year.
depreciation are the same.
What was that, Nathan?
Depreciation and since we don't have the previous year, the accumulated depreciation will be 1,000.
Okay, and the book value will be 9,000 because we're just okay.
Yes. Yes.
Got it. Okay, thank you.
Mm-hmm. Yes. We will practice this in the exercises today. So don't worry about solving the rest of this PowerPoint. But yes, okay. Any other questions?
No.
All right, so let's dive right into the 11.2 exercises. Okay. So let's start off with this question number 1. Okay. Okay, so question number 1 says that you purchased a cash register, okay, for $300, okay, with no salvage value. All right. Its useful life is 5 years, and its capacity can create up to 5,000 receipts. Okay. And again, you put this cash register into service as of January 8th, right? So let's go ahead and fill this table here. So what did I buy?
A cash register.
Okay. How much was this cash register worth? $300. Okay. What was my salvage value?
0.
I would think it was, yes, good, 0. Okay. What was my estimated useful life?
5 years.
5 years. Okay. And then date that I placed into service?
January 8th.
January 8th. So in this case, right, when am I going to be depreciating my asset? January. So this case, assuming that we do depreciation at the end of the year, we're going to depreciate it for its full year. Right? Because I'm doing it from January all the way to December. Okay? So let's go ahead and start with the very, very first one. What is going to be my depreciation basis?
The $300.
The $300, right? It's going to automatically be whatever my asset cost is. Okay? So then what is going to be my rate?
24.
Right? 1 divided by the estimated useful life times 2, right? Which gives you 0.4, right? So then my first years of depreciation expense is going to be
$120.
$120, okay? So then what's my accumulated depreciation for the first year? $120, which then brings my book value to become
180.
180. Excellent. So then now that I have my ending book value for year 1, what's going to be my depreciation basis for year 2?
180.
The 180, right? You're going to carry your book value over, okay? All right. So what's my rate going to be this time?
The rate
The rate stays
stays the same.
the same throughout all 5 years, okay? So then let's see what happened next, okay? So now what's my depreciation expense going to be for year 2? $72. Good, right? So therefore, what is going to be my accumulated depreciation?
192.
192, which then brings my book value to be
108.
108. Okay. So then what is going to be my depreciation basis for year 3?
Same thing, the book value.
Same thing as my previous year's book value. Good. So 108. So what's 40% of 108?
4320.
4320. Okay. Which then my accumulated depreciation is going to be
235.20.
235.20. Okay. My book value for year 3 is going to be $64.80. So already on year 3, I'm already really close to getting rid of my asset. Okay. So then year 4, depreciation basis is going to be the $64.80. Okay. So what's 40% of $64.80? Or in this case, what's the depreciation expense for year 4? Did everybody get 25.92?
Yeah.
Okay. So now year 4, I have $25.92 for depreciation expense. So what is going to be my accumulated depreciation for year 4? 261.12, which then brings my book value to be 38.88. Okay. Which once again, we're going to carry this value over. Okay. So then what is going to be my depreciation expense for year 5? Right. What was that, Nathan?
15.552.
15.55. Okay. So then what is going to be my accumulated depreciation?
The 276.67.
Which then brings my book value to become now
23.33.
23.33. So as we see here, right? Because it's going to take us forever to actually get to 0. Okay, you're going to keep depreciating it, and notice this. You're basically cutting it in half every single time, right? We went from 300 to 320, or 300 to cut it in half by 320. I'm sorry. 300 minus 120 to cut it in half, right? To now make it become 180. And then 180, we multiplied it again and cut it in half again to be $72 to then now bring it to a 108. So if you notice this, right, we're almost cutting it in half every single time. Now, as we slowly get down to the very end, right, it has reached its end of its life, right? Because we started in January, therefore by the 5th year, right, it is now $23.33 worth. Now, of course, because it's a cash register, right, your assumption here is that, yes, you can hold on and keep the cash register, right? It can last longer than 5 years. In fact, it can last up to 7, maybe even 9 if you keep it in real good condition, right? Maybe you need to do a little maintenance here and there. But yes, this asset can actually continue its life. However, once you reach its estimated end of its useful life, that means it's going to get slower. Maybe you need to replace a few buttons. Maybe the wheels on there isn't going well. The ink isn't printing on the receipt correctly. Things are going to go bad when you reach the end of its life, okay? So if you ever come to this portion right here where you only have $23.33 worth of your asset left, you have 2 choices. You can continue its life by, continuing continuing using it, or you can stop here and just write off this $23.33 as either you could discard it. So if you kept reading the end of chapter 11, it talks about what happens when you disposed fixed assets. Okay. So yes, there are many ways that you could dispose fixed assets. You can either just take a loss on the asset, so you could call it loss on disposal of asset. You can also try to sell it, but I'm pretty sure you're not going to be able to sell it. It's a cash register that's been used. So there's a lot of things that you can do, and you may need to either recognize a loss or recognize a gain. Okay. But yes, that's what you can do because it's already reached its end of its life. It's probably going to break down sometime soon. Okay. So next section we have here is going to be, we're going to journalize this adjustment entry for the first year and for the second year. Okay. So assuming that the depreciation journals are done at the end of the year. So what is going to be my journal?
Depreciation expense and accumulated depreciation.
Good. Depreciation, expense, and accumulated depreciation. I'm going to use accum for short. Okay? And this time, for my first year, what amount am I going to depreciate it for?
$120.
120. Okay. What about for the second year? So as we know, right, the journal should stay the same. Okay. However, what happened on the second year? What was my depreciation expense for the second year?
72.
The $72. Okay. Okay. Any questions for this example right here?
When you said that you can either keep using it or write it off, if you write it off, you will just, instead of using 2333, you will use 0.
Yes, if you're writing it off, if you're trying to get rid of the asset, you don't want it no longer in your books, you have to display how you're going to get rid of it. So in most cases, you just, yes.
0 work backwards.
No, not work backwards. In this case, no, you wouldn't work backwards. You would just get rid of it, as in like sell it, dispose it, and it would just be 0. And then you would dispose it and take a loss for $23.33.
Oh, okay.
Mm-hmm.
So the only way we can go backward is if there's a salvage value.
Correct. Because if you have a salvage value of 0, you could keep going on and on and on and on, because it's the next one's going to be whatever half of 23 is, which is 12. Then half of that, which is 6, and then half of that's 3, and then half of that is $1.50. You know, as we keep going, you'll never reach 0. Okay, you might reach 0 probably at the end of year 20. So in this case, right, and then of course, if you're trying to get to 0, the only thing is that your asset is probably so old right now because it's going beyond its life, right? A lot of things are going to break down. Buttons need to be replaced. The roller wheels might need to be replaced. Ink needs to be replaced. Okay. Okay, so let's go ahead and do the second example here. Okay. So this time, we decided to purchase a computer, okay, for $1988, okay, which includes all fees and taxes, with a salvage value of $200, okay. All right, its useful life is 5 years, and you put this computer into service as of August 25th, okay? Assume that depreciation is done at the end of the year, okay? So let's go ahead and fill out our little table here. So what did I purchase? I purchased a computer. How much was the computer worth?
1988.
Okay, 1988. Okay. What's my salvage value? 200. Okay. What is going to be the estimated useful life?
5 years.
5 years. And when did I place it into service?
August 25th.
August 25th. So in this case, when am I going to actually depreciate this? What was that, Nathan?
So this is after the
Yes. since it's after the 15 days, it's going to be starting September. Okay, so September, October, November, and December. So that's 4 months that for the first year that my asset is only 4 months old. Okay, so we'll keep that in mind. All right, so let's go ahead and solve for our table here. So what's going to be my depreciation basis?
The 1988.
1988. Okay.
I have your rate to be 40%.
40%, right? 1 over its estimated useful life of 5 times 2,
5 times 2.
40%. And we know that this rate will probably will stay the same all the way through. Right?
And then I have the depreciation expense
Okay.
at 265.07.
268. Okay, try that again.
265.07. Right. Not. Oh, okay. 795.20.
Okay. Yes. Okay, so in this case, I don't know what you use your depreciation basis for, but it should have been 1988.
88.
Okay. All right, good.
All right.
Which your accumulated depreciation for the first year is going to be?
And the accumulated should be the same amount, the 795.20.
Good. So then what is my book value going to be?
We help with that one.
So what's your book value? So what's the formula for book value?
Cost of asset minus accumulated depreciation.
Good. So in this case, right, what is my cost of my asset? 1988. And we solved for our accumulated depreciation to be $795.20. Right? So then, what should be your book value?
Isn't it the amount is not for the whole year?
Yes. But just go ahead and just solve for it, and then we'll work backwards.
Oh,
1192.80. Now, Nathan recognized this. For the first year, I can't depreciate it for $795.20.
Oh.
Why?
Okay.
Because this is for the whole year.
Whole year. Okay.
Okay? How old is my asset?
only 4
It's
months.
5 years. It's just 1 year, right?
Okay.
Yeah, no,
But when did I place into service?
The asset is
In
only
September.
Okay, so we're going to depreciate as of September, right? For the very first year, if I said I depreciate my assets at the end of every year on December 31st, I only place my asset in September. September, October, November, December. How many months can I actually depreciate this for?
4 months.
You can only depreciate it for 4 months because on the first year of its life, it didn't even reach a year. It was only 4 months old at that point. So in this case, $795.20 cannot be for the first year because my asset's only 4 months old. So in this case, how much should it be now?
So 795.20 times 4 divided by 12.
Good.
It should be 265.06.
How much?
265.06.
Okay.
Okay, you can round it.
Yes, I rounded, yes.
What was this formula again? 795.20 times 4 divided by 12?
Correct.
Yeah, you can only depreciate it for
Out of 12
depends on how
months.
many depends on how many months you have left. That
Okay.
number could change.
Mm-hmm.
Okay, so this is kind of like a partial.
Exactly. Because, yeah, I mean, you can depreciate it for a whole year, but then you just used up 8 months of its life for no reason. Right? We're treating our assets like our babies, right? The day that they're born will be the day that you start counting how old they are. So in this case, right, I placed this in service at the end of August, which then I treat it as if it's going to start its birthday in September. So therefore, counting, if the very first year was December of that year, how many months is it? It's 4 because I have September, October, November, and December. I have 4 months that I actually use the asset. So in this case, yes, the formula is going to be the depreciation basis times rate times 4 divided by 12. Okay, or you could take the 795.20 and divide times it by 4 and divide it by 12, or you could divide the whole thing by 12 because that's how much it is for the month, and then multiply it by 4. You're going to get the same answer. Okay, so good. So it is 265.07. Okay, and because now that was for the whole year, and now this reflects for just 4 months. Then we got to recalculate our book value. Okay.
Excel did it right.
Yes, because I cell referenced.
Okay, that book value for September.
Should be now 1720 2293. Yes. Okay. So then what about for year 2? What's my depreciation basis for year 2?
The 1722.93.
Okay.
$689.176.
Okay. So this is for the whole year because now that I finished off my first year, right, from September to December, now I'm going to depreciate my asset from January all the way to December. So 1 full year, which is going to be $689.17. Okay. So then what is now going to be my accumulated depreciation?
14.87.
What was that? Okay.
Oh,
The 954.24. Yeah.
Okay, so I think, Nathan, you were solving for the book value, right?
sorry.
No, the book value should be 1033.36.
1033.
I got 76.
Good,
Oh,
1033.76.
good.
all right.
Right? Because if it was 1988 even and you have 24 cents, 76 cents should be correct. Okay. So then what's my book value for year 3?
$1,033.76.
Okay. what is going to be my depreciation expense now?
413.50.
413.50, good. Accumulated depreciation?
I have it as 1367.73 or 74. My
Good.
computer's okay. 74. And then I have the book value as 371.16.
371.16. No, I did not get that.
I think that's my other. 620.26.
620.26. Excellent. Okay. Which then, so now that I solved for that, I can go ahead and bring that value down. Okay. So then, let's go ahead and continue on. So what is going to be my depreciation expense for year 4? 248.10, okay. Accumulated depreciation.
1615.84.
Good. Which then brings my book value to be
372.16.
372.16. Good. All right, let's solve for the last one. Okay. 372.16 is going to be my depreciation basis. So what is going to be my expense for year 5?
I got 148.86.
Okay. To bring my accumulated depreciation to be
1764.70. Oh, okay.
good. Excellent.
And I have my book value as 223.30.
223.30. Good. So therefore, I haven't reached my book value yet. Second thing is, how old is my asset right now?
5 years.
Is it really 5 years?
No, it's 4 years and 4 months.
4 months.
Exactly. So therefore, we can carry on for a 6th year. So let's go ahead and follow through. All right. If I were to put 23.30, okay, and I know that I'm going to depreciate it again by 40%. So what's my depreciation expense going to be for year 6?
89.32.
Okay. And then my accumulated depreciation?
1854.20.
Okay. Oh, 5402.
Okay.
And then last but not least,
The last one I have as 133.98 as the book value.
okay. Now, can I ever have this book value?
No.
No, because my salvage value is what? My salvage value is what?
200.
200. So in this case, I fell below salvage value. So therefore, this cannot be. I have to start working backwards now. Okay? So what I'm going to do here is I'm going to go ahead and strike this through. Okay, come on. I'm going to strike this through. So maybe how come this window isn't pop? There you go. I'm going to go ahead and strike through. because that value cannot be there. But just to so that you guys can look at the answers, you guys know where this number came from. Okay. So in this case, right, what should my book value actually be at the end of its life?
200.
It needs to be 200. Okay? So from this idea here, right, if I need to plug into my formula, right, but I'm given a few things, right? So in this case, right, my formula to solve for book value is going to be, what is it? Book value is equal to asset cost minus accum depreciation, right? So same idea here, right? This is going to be, what is it? A equals B plus C, or in this case, minus C, sorry, right? I'm going to be working backwards. So in this case, right, I know what my book value is. My book value currently is now 200, all right? And I also know my accumulated depreciation, my asset cost is 1988, right? And now I need to solve for what the accumulated depreciation is, right? So in this context, right, how would I be able to solve for this?
Subtract.
You could either subtract or you can, yes. So in this case, right, I can flip my formula over, right, to reflect this, that I'm going to solve for my accumulated depreciation, right, is going to be my asset cost minus my book value. And since I have the information here, what is going to be my accumulated depreciation? What is 1988 subtract 200?
1788.
1788, right? So then now I have one more step to go, right? Let me just keep inserting more lines here. So I have one more step to go, right? I need to solve for my depreciation expense, okay? Now here's one thing I know. In order to solve for my accumulated depreciation, right? I know from the accumulated depreciation it's going to be my previous year's ACUM, right? Plus my current depreciation expense, which is exactly what I want to solve for. So in this case, I know what my accumulated depreciation is. It's 1788, right? It is equal to my previous year's, which I know, which is 1764.70, all right, plus my depreciation expense. Therefore, how would I be able to solve for my depreciation expense?
Are you subtracting 1764.70 minus 1788?
Yeah, you're going to be subtracting the 1764.70 from the 1788. Yes, correct. So in this case, what is going to be my depreciation expense?
2330.
Okay, 2330. Okay. Boom. And that's it, right? Now, of course, if you saw it this way, right, if you saw that it was 2330, you can automatically know that, okay, well, the next one I have to do is I have to depreciate it by $23.30, and you would have gotten your answer that way too. You could have worked forward instead of backwards. But again, most cases will not always be like that. It will be a number that you can have to actually truly have to figure it out yourself. Okay? But in this one, you can kind of see the hint right here. I have to get from 230, 200, right? And I'm right now at 223.30. So how much do I need to depreciate? $23.30. Okay. So that's what happens when you reach the point where your salvage value falls below your book value, or your book value falls below salvage value. Okay. All right. Any questions there?
Not a question, but a statement. It's kind of confusing. Yeah.
Okay. It's just
Yes.
confusing. Okay. Okay.
That's why I say it's not a question, it's a statement.
Okay. So in this case, right? So you have to work backwards, especially when you have your salvage value or your book value fall below salvage. Okay, that's just the rules. Because you absolutely, if you're stating that your asset does have significant value, it must hold it. All right. Now there are some rules and regulations that you can do, which is something that's you're going to be learning in more advanced level of accounting. Is that yes, you can appreciate assets, you can depreciate, and then you can also add any fixtures, any maintenances that allow it to either one, extend the life of the asset, right? So in this case, right, this is a computer. I can upgrade my computer by getting a new hard drive, right? I can add more RAM to it, and that's going to up the cost and also extend the life of it. And that's also part of the section where you learn about the loss on disposal of asset. So yes, you can revalue your assets by making fixtures or adding stuff to it. Once again, that is advanced level of accounting. Okay. In this case, once it reaches its life, that's it. It's done. Okay. So then let's go ahead and journalize. Okay. So once again, the journals are going to look identical to the previous one, okay? Except now, let's go ahead and what is the depreciation expense for the first year? $265.07. Good. What is the depreciation expense for year 2?
$689.17.
Good. All right. All right. And that is it for chapter 11.2. Right? Okay. Any other questions for this part?
I have a question.
Okay.
So in the exercise, in the first example with the cash register, the reason why we didn't have to work backwards is because there was no salvage value.
In this case, yes and no. Yes, because the salvage value is 0. As in, the more you keep calculating it, eventually at the end of its like 10 or 11th year, you'll finally reach 0. Okay? But yes, but But, I mean, no, because in this case, right, because of the idea I'll never meet 0, there is no need for you to work backwards.
Okay,
Yes.
thank you.
But in this case, right, we have a salvage value. So most cases, right, oftentimes a lot of assets, they may not even make it to their life, the end of their life, because you're depreciating it twice as much. And because of that idea, right, it may reach its life, maybe it might not. But the idea here is that if we have to keep track, because we're constantly looking at its book value. Okay, that's what we're using to depreciate it. And at that point, you do need to make sure that your salvage value does in fact reach, or your book value does in fact reach your salvage value. Okay.
Can you scroll down a little bit so I can see those formulas that we use for this example again, please? Thank you. Thank you.
Okay. All right. Any other questions?